I'm Cynthia Rowland, and this is episode 101 of EO Radio Show. Today's episode is the second in a three-part series addressing several critical compliance topics relevant to international grant-making by U.S. public charities and private foundations. These are the anti-terrorism rules, the income tax withholding rules, and special rules for private foundations. By way of background, all U.S. charitable organizations that make grants to organizations or individuals that are not resident in the United States need to be aware of a couple of general requirements, and private foundations also have an extra set of concerns in order to be sure that the expenditure outside the United States is not penalized as a taxable expenditure and that it does count toward the foundation's minimum distribution requirement. In episode 99 of the show, I launched this series with an episode focused on introducing the Patriot Act rules that apply to all grants, international and domestic, but they're of particular interest when we're talking about international grant making. In this episode, I'll provide a brief overview of the income tax withholding rules that apply to payments for services and that come into play when making a grant to an international organization that provides some services in the United States. The third installment of this series will focus specifically on the special private foundation rules, that is, the expenditure responsibility, equivalency determination, and other techniques used by private foundations that make grants to international organizations. Welcome to the EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. Today's episode is the second of a three-part series introducing key topics for charities and foundations that make grants to international organizations. First up was my primer on anti-terrorism best practices. Today, we cover part 2, the withholding rules. So here is an overview of the rules that require withholding of taxes on grants made to foreign organizations or individuals by United States charities. When I refer to a grantor in this section, I mean a charity incorporated in the United States that is described in Internal Revenue Code Section 501c3. And grantee refers to the foreign organization or individual recipient of the grant. Links to the IRS sites and publications that describe the details and procedures for withholding and payment of withheld taxes, as well as documenting exemptions from the withholding requirements, are in the show notes today. So the first step is determining whether the grant is for exclusively foreign activities. A grantor making a grant to a foreign grantee for activities entirely outside of the United States should clearly document that all of the grant funds must be used exclusively to support activities conducting outside of the U.S. In that case, the grantor is not required under the Internal Revenue Code to withhold on the foreign grant or to collect withholding certificates from the grantee. If, however, the grantor is uncertain as to what portion of a grant may be used to fund activities in the United States, for example, there might be a possibility of travel to the United States for conferences or seminars by the grantee. In that case, the grantor must withhold U.S. taxes owed by the grantee unless certain exceptions apply, and I'll talk about those in a minute. So it's important to keep in mind that it's the grantor's duty to withhold taxes if that's an applicable rule for the particular grant. It is the grantor's responsibility if it makes grants or awards prizes from a U.S. source to foreign individuals or foreign organizations who perform all or part of their grant-funded activities in the United States. It's the grantor's responsibility to withhold U.S. taxes from these payments. A grant or award from a grantor to a non-resident alien, foreign corporation, or foreign trust for the conduct of activities in the United States is generally subject to 30% withholding requirement. So that's 30% of the entire grant award. If it's a $100,000 grant, then the amount that has to be withheld would be $30,000. And that withheld amount gets paid over to the IRS on behalf of the foreign grantee. So that's how the withholding works. So now let's talk about some exceptions and exemptions so that these withholding tax rules wouldn't apply. There are a couple of exceptions and exemptions from the withholding requirements that I'll talk about here. For example, certain scholarship payments to foreigners studying or lecturing in the United States on certain types of visas are subject to a reduced withholding rate at 14%. But if a foreign grant does not fall within that exception to the 30% rule, there's two exemptions that exist that may eliminate the withholding requirements for some grants to foreign organizations and individuals. A grantor is exempt from the withholding requirements on its foreign grants that are spent partially or entirely in the U.S. if, first, the recipient qualifies for exemption under a U.S. tax treaty, or another exception we'll talk about is if the recipient organization can establish that it could qualify as a U.S. tax-exempt organization. So let's drill down a little bit into those rules. The first exception that we'll discuss is the applicability of tax treaties. If this rule applies, no withholding is required because the grantee qualifies for a tax exemption under a U.S. tax treaty, and that grantee still has to provide the grantor with a completed certificate that establishes that qualification. This is the Form W-8-BEN, which is used by individuals, or Form W-8-BENE, which is the withholding certificate used by entities to claim the treaty exemption. This Form W-8-BEN must state the relevant treaty provision and describe the reasons why the grantee meets the terms of the treaty. There may be treaty provisions, for example, that are specifically applicable to exempt organizations. The grantee should consider attaching an affidavit that contains these specific reasons or establishing its public charity status under the applicable foreign laws. The second area to talk about for avoiding the withholding requirements is an exception that applies if the foreign grantee is the equivalent of a U.S. tax-exempt organization. So these rules are worth looking at if the grantee is a foreign organization that is described in the technical rules of Section 501c3, 501c4, or certain other subsections of Section 501c of the Code. In those cases, no withholding is necessary, even if the grantee's activities are conducted in the United States. However, the grantor can rely on this exemption from withholding only if, prior to paying the grant, the grantee provides the grantor with a withholding certificate that includes a number of technical requirements. First, a completed Form W-8-EXP. So that's a different W-8 than the BEN I talked about a minute ago. So the grantee has to provide a completed Form W-8-EXP that includes its taxpayer identification number or employer ID number. Second, the next technical requirement is that the foreign grantee provides either a determination letter from the IRS or an opinion letter of U.S. counsel that concludes that the organization is in fact described in a subsection of 501c of the Internal Revenue Code. And the third technical requirement is that if the grantee is a public charity described in Section 501c3, that grantee provides an affidavit setting forth sufficient facts concerning its operations and support to enable the IRS to determine that the grantee would likely qualify as a publicly supported charitable organization under U.S. law. Any opinion of counsel or affidavit supporting the U.S. equivalency determination of a foreign grantee must be renewed prior to any subsequent grant payments if the grantee knows or has reason to know that the grantee has undergone a change in facts or circumstances relevant to the determination of the organization's status under 501c, or whether the grantee is or is not a private foundation or public charity. The grantor does not, however, have an affirmative duty to inquire as to a change of circumstances when it makes a subsequent installment on a grant or renews a grant to that foreign grantee. So this equivalency determination is most easily understood in the context of, say, a foreign university. Many universities can easily be determined by U.S. counsel to actually be described in Internal Revenue Code 501c3 and that they are public charities. So it's a very useful exception to the withholding rules. So in considering the tax treaty exemption and the equivalency determinations, it doesn't end for the grantor with collecting the certificate. There is an overarching caveat to remember as a grantor, and that is do your own homework. There are due diligence expectations from the Internal Revenue Service. A grantor can rely on the information and the certifications provided by a foreign grantee on these required forms that I talked about, unless the grantor has actual knowledge or reason to know that the information is untrue or incorrect. A grantor is deemed to have reason to know that the information is untrue or incorrect if it has knowledge of relevant facts or statements contained in the withholding certificate or other documentation that would cause a reasonably prudent person in the position of the grantor to question the claims made. For example, if a grantor has information in its files that is inconsistent with the information on the relevant W-8 tax form, the grantor may subject itself to penalties if it relies on an inaccurate Form W-8. The Form W-8 must be signed by the beneficial owner that receives the grant funds, that is, the foreign grantee itself. And only in limited circumstances can the grantor lawfully rely on a certificate made by an agent or an intermediary of the grantee. So what's the downside of failed compliance here? Well, there are penalties that are imposed on the grantor for failure to obtain the appropriate supporting documents or failure to withhold. In circumstances where a grantor believes an exemption applies because of either a tax treaty or a U.S. equivalency determination, and therefore is not required to withhold income taxes on the grant, the grantor nevertheless must collect the completed federal tax forms and other documents described above, or it may be subject to a penalty. A grantor that has failed to withhold or has failed to gather the appropriate documentation in support of the exemption faces potential penalties and interest on the amounts that should have been withheld. Now, a grantor can avoid these penalties by demonstrating to the IRS a number of things. One, that it relied appropriately on an available presumption that the recipient was a U.S. person, or that the grantee did in fact pay the tax owed, or that no tax was actually owed by the grantee. But these are all difficult things to prove once you're under the microscope of the IRS. On the other hand, even if no underlying tax is due from the grantee, a grantor not entitled to one of the above presumptions that has failed to document and withhold properly may be liable for interest on the amount that should have been withheld until such time as the grantor obtains the proper documentation. If the grantor not only failed to collect the appropriate documentation, but also should have withheld income taxes on the grant and failed to do so, the IRS may collect the amount that should have been withheld, plus interest on that amount and penalties from our U.S. grantor organizations. In other words, in the worst case scenario, the grantor pays the grantee's U.S. income tax. So let's talk now about a few planning strategies for U.S. grantors that want to make international grants. First of all, the easiest way to avoid any of this withholding morass is to avoid the withholding requirements by specifying in the grant award letter that no funds may be spent in the United States. So this is relatively easy for disaster relief, for example. A grant to a foreign organization for disaster relief that meets all the other criteria and that specifically says all of the disaster relief funding will be spent in the foreign country where the disaster occurred would be a good example of a grant that is not subject to withholding. If it's not possible to limit where the funds are spent, then sometimes it's useful to determine whether an exemption applies, that is, the tax treaty or an equivalency determination, and in that case, obtain from the foreign grantee the completed Form W-8-BEN or BEN-E if you're claiming an exemption under the tax treaty, or the W-8-EXP if claiming the grantee is the equivalent of a U.S. tax-exempt organization. These forms, as well as information about tax treaties, are available at the irs.gov website. Another idea, if no exemption applies and the grant funds might be used in the United States, then some grantors will divide the grant into two parts. One grant that will definitely not be spent in the U.S. and therefore is exempt from withholding altogether, and one grant that may be used in the United States, say for travel to meetings in the U.S. or other such things, and the grantor withholds only on that portion of the grant. Finally, if it's clear that a portion of the grant will be spent in the U.S., no exemptions apply or worth pursuing because of the cost-benefit trade-off, and the grant can't be bifurcated into U.S. and non-U.S. parts, then the grantor must withhold on the entire amount of the grant, and sometimes you just consider that a cost of doing the grant-making activity that's so important for the organization. So those are some practical planning strategies. And that's all for this episode. Be sure to check out the show notes for links to these resources that I've mentioned. Also, Farella Braun Martel has a YouTube channel, and the nonprofit playlists for the EO Radio Show podcast organize all the past episodes to make it easy to find information on topics relevant to you. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun, and Martell. If you have suggestions for topics you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.